Welcome viewers. This is Dr. Abraham Joseph from Money Matters. Today we are covering session 8 or part 8. Today's topic is fundamental analysis. Let us go in detail about this fundamental analysis. A business has got a strong foundation. The strong foundation of a business or a company is identified in the fundamental analysis. Fundamental analysis refers to it is the examination of a company by analyzing its financial health, the business plan, and the business performance of the company during a given particular period of time, especially 1 year. The goal is to know whether the current market price is undervalued, overvalued, or fairly valued. The overvaluation means the price of the share is more than expected price. Undervaluation means the price is very low, maybe a right time to buy, and fairly valued is it says that this is reasonably valued. This is used by the long-term investors with an objective to buy at a low price and sell at a high price. We shall study these things one by one. In the fundamental analysis, normally these 10 values are analyzed. First one is increase in sales. Sales is also known as revenue. That a company is required to increase its sales. Then increase in the net profit or earnings. Third point is earning per share. Then fourth point is PE ratio, price to earning ratio. Then fifth one is debt to equity value or equity ratio. Then ROE, that is return on equity. And the seventh one is return on capital employed or popularly called as ROCE. Then whether the company distributes dividend regularly. Then the ninth one is leadership and the management. Whether the leadership or management is dynamic or creative, that kind. And the last one is market share and brand of the company or brand of the product. So these are the 10 points that has to be analyzed in the fundamental analysis. Now let us elaborate one by one. Welcome back. What are to be analyzed? In the fundamental analysis, we need to analyze 10 different points as you have seen just now. First one and very fundamental is about that there should be a regularly increase in sales or revenue every year. If the company might have, let's say for example, achieved 100 crores of sales last year, this year it should not maintain at that same level. Maintaining at same level is not considered to be an appreciation or any growth or performance. It should increase it at least by 10%. So that every year sales will increasing, and proportionately the profit also should increase according to that ratio. So sales increase is considered to be a better point in the fundamental analysis. Second point is increase in the net profit or earnings. A company should proportionately increase the sales profit. Not that the company just increases the sales, but if there is no increase in profit, that means they are spending too much or expenditure is too much. So proportionately it should increase also because of the scale of volume or scale of the sales revenue. The profit should be rather proportionately more than what was achieved earlier. So a company should regularly, periodically make a profit. When I am saying periodically, quarterly sometimes they may not achieve expected this one because some quarters may affect, but overall for a particular period of 12 months beginning from 1st of April to 31st March, the earning should increase. The third point is earning per share. Every share is earning some amount of money, some amount of cash on the basis of the return. So that is also to be calculated. So what is EPS and all, earning per share and all calculation we will see at a later period of time when we conduct regular classes. Then comes PE ratio, also known as price to earning ratio. Now what is this PE ratio and how much should be the PE ratio? It varies from company to company. Normally, a P ratio for bank should be say less than 15 by 1. And in case of other companies, regularly manufacturing companies, it should be less than 25. That is considered to be a reasonable one. What is the meaning of a P ratio? If a company's P ratio, let's say for example HDFC's P ratio is 15 by 1, that means that to earn 1 rupee, we have to pay a price of 15 rupees. And in case of non-banking company, or in case of say for example Reliance Industry, if the PE ratio is 25, it means that to earn 1 rupee, we have to invest 25 rupees. So calculation is just based on price divided by earning. Then the next point is debt to equity ratio or debt to equity value. What is the debt to equity value? A company is not supposed to run its business entirely on debt or loan or borrowings. A meager amount of debt is okay, considering its equity value is 1% or 5% is accepted as equity debt. Next one comes to return on equity or ROE. What is the percentage of return on the equity invested? Every year, yearly it should be calculated. So ROE stands for return on equity, or rather to say it is the net profit on equity. ROC is net profit on capital employed. Capital employed and equity are not the same. Capital employed includes equity plus any borrowings and reserves also. Then the next one is dividend disbursement. Every company that distributes dividend is shareholder friendly. Normally, the companies distribute its surplus profit, or out of the profit earned, certain percentage of profits as dividend. If the company is not distributing dividend, it may use those profit for some development or capex purposes. But it is always good that the company do regularly give dividends. There are a lot of companies that gives dividend, especially the petroleum companies of ONGC, Bharat Petroleum and all. They keep on giving quarterly the dividends. So dividend giving is a good indication. Then leadership and management. Leadership and management, how the top is executing, planning and thinking about its vision and how to implement. A top leader in a company is an indication that the company is performing well. Show me a successful leader and I will show you a great company. That quotation perhaps you might have heard. And show me a poor company and I will show you a poor leader there. So a strong leadership is also considered as very fundamental. And the last one, not the least one, market share and brand. A company being in the market for a long period of time should have achieved a market share of its services or product to at least to an extent of 25 to 30% or more. At least 25 to 30%. Then only it is a leader in the market. So a market share of more than 25% is considered to be good, and its brand name. People should know the product by its brand. They should not look at the price tag of the product, but simply looking at the brand they will buy. So such company has got we call a better company or a great company. So all these points must be considered to decide which company or which stock to buy. That's all about today. So we'll see tomorrow what the global perspective of share market and what are the global stock exchange that must be considered that has got an influence on Indian stock market. Thank you very much. Have a wonderful day.